So I'd like to welcome to the stage our moderator for this panel is Tayo Odunsi, CEO Northcourt Real Estate. A round of applause for him. He is in conversation with Kunle Osilaja, Head Real Estate EcoBank, Adeni Falade, Managing Director, Crusader Sterling Pensions, Nigeria, Patrick Ilodianya, MDSFS Capital, Fola Ayesimoju, Founding Partner, Themis Capital Management, Bumi Archer, Leadway Assurance Company Limited. I hope we have enough seats. Let's see. One person missing. So it's Kule, Adeniyi, Patrick, Fola, and Bumi, moderated by Tayo Odunsi. Okay. This is going to be a 40-minute session. We aim to finish by 11 o'clock.
Okay, thank you so much, Didi. Good morning, ladies and gentlemen. I trust we truly enjoyed Akim's presentation. And Akim, I don't think you should leave just yet because you ordinarily should be part of this panel. I think
we would be very happy if you would be happy to be part of the panel.
The right to bring Hakim on this panel. I think. Yes, because some of the things that you've touched on, we absolutely need to.
And then that would be a good opportunity to get in some questions for Hakim as well. So can you join us here, please? Thank you very much. A round of applause for him. We want to make time for questions, so keep to time.
Okay. All right.
Thank you.
We'll just quickly dive right into it. Just a few opening remarks. Some of the things Hakim has touched on. Globally, banks, pension funds, insurance companies, and more recently, REITs have been major sources of finance for real estate and infrastructure development financing. Nigerian pension fund industry currently stands at 8 trillion naira and is growing. It's grown 1.5% quarter on quarter, and that's actually faster than GDP is growing. The insurance sector is in a consolidation process, and also its regulatory limits allow it to invest at least 35% of life insurance in real estate and 25% in non-life in real estate. With the birth of the ISA 2007, the regulatory stage was set for REITs in Nigeria, and a lot of follow-on orders, circulars, waivers, concessions have given more access for REITs. But albeit there's just about 3 REITs currently, and so these are some things that we need to discuss. So we'll also try to see if we can touch on other private sources of capital into real estate, such as crowdfunding, private equity, venture capital, and the likes, and we'll see how we'll take it on. I'll just start off with, perhaps I should start off with Patrick, all right, touching on pension funds, because, you guys have I'll not start with Patrick on the pension funds because you're a REIT fund manager. I'll start with we need, yes, insurance. So, I mean, I just mentioned that you have quite a lot of leeway in terms of your regulatory approval to be able to fund real estate assets. From Crusader's perspective and the industry as a whole, how well are you driving capital into real estate currently?
Okay, thank you. Thank you very much.
Yes.
Well, it's always a very interesting conversation when we talk about real estate. The truth of the matter is Akim has really talked a lot about this, and he's even made my job a lot easier. Nigerian pension fund currently, as you rightly said, sits on about 8.3 trillion naira. And indeed, the capital is available to be deployed across various asset classes. And in fact, the regulation has rightly identified the need to deploy those funds, even from safety and return, as well as social perspective. Around about July, a new regulation came out, and we now have what we call multi-funds. We used to have just one fund before. which is retirement, global retirement savings account. Now we have about 4 different types of funds. And the interesting thing is that allocation to real estate has changed a bit, and this is the way it works. For real estate, monies can only be accessed via 2 vehicles. One is REITs, and the second one is via mortgage-backed securities. And so,
you can't put money directly into
real
estate?
No. There can't be any direct investment in real estate from Nigerian pension fund. And why? Why is that so? It's because in Nigeria, we are operating what you call the defined benefit scheme. When people talk usually about pension fund, they are talking about, we are operating contributory pension scheme in Nigeria. When people talk about pension fund, generally, they are talking about defined benefit scheme. What happened is that in 2004, Nigeria migrated from defined benefit scheme to contributory pension scheme. Now, what's the difference? Under contributory pension scheme, you have what you call daily valuation, all right? All monies that come into the fund are coming in to buy units, all right? So when you retire, it's the total units you have accumulated times unit price that gives you your exit, that gives you your total package.
Okay.
So what that means is on a daily basis, all asset classes must be marked to market. And so it then becomes challenging to be investing in direct real estate under this scenario, because valuation is a big problem when that happens. Because one fund can come and say, this room is 30 billion, and that one will say, it's 50 billion, and then another one will say 60 billion. So that's going to present a huge challenge. All right, so that is why the law does not allow, or the regulation does not permit direct investment in real estate.
And just to follow on that, this contributory method, doesn't that make the pension funds very, very capitalist in nature and not, seeking to do more of social good?
I'll come to that. So the way it then works is, because of that, the only asset classes that could then fit into that model are REITs and mortgage-backed securities. Why? They could easily be listed on the stock exchange, and then they are transparent, they are liquid, and then managers can sell and can buy at their own instance. So that's the way it works. But the challenge we now have in this environment is that those instruments are not available. Now, in terms of limits, I'll tell you what has been allowed right now. There is a 40% limit for mortgage-backed securities. That comes to 2.4 trillion naira. And it's totally unused.
But the assets don't exist.
The assets do not exist.
Okay, so
now, let me tell you about the second. The second one, which where REITs fall in. All right? That one has 20% allocation, which comes to about 1.2 trillion naira. It's also totally unused. Total allocation to REITs as we speak is about 0.2%. Again, it speaks to what Akim spoke about the other time. And so, but on a general basis, what are those managers looking for? It's a question of risk and return. All right? So managers are basically looking for real returns on a risk-adjusted basis.
Okay.
What do I mean by that? Inflation in Nigeria is running at about 12%. So managers are basically looking for anything in excess of that 12%. If inflation falls to single digit of 9%, managers are basically looking for things around 10, 11%. On a
and
risk
the assets that currently
basis.
exist potentially cannot give that kind of return.
Except few ones. Key one there is federal government bonds.
Okay, when I said assets that exist, I mean
real estate.
Assets.
Yes, obviously.
Okay, so let me jump to Fola and let's talk a little about these real estate assets. Why are we not able to create the kind of assets that pension funds, insurance companies are willing and able to finance?
Yeah, okay. Look, I'll give my initial thoughts, and I'm reasonably new to the real estate industry. I think there are two aspects to real estate returns. There's your ongoing yield, and then there's capital appreciation. And I think what the investing public, particularly the pension funds, focus on is the ongoing yield. And I would say it's extremely difficult for you to get ongoing yields that are comparative to fixed income, at least in Nigeria. So the question then becomes, how do you deliver a total return that exceeds government bond yields? And it's reasonably similar to equities. If you look at a stock, there'll be a dividend yield of, let's call it 3 to 5%, where you expect the stock price to appreciate. And then you get an overall return that is comparable to or in excess of federal government bonds. And there are several ways to create capital appreciation in real estate, but the path that is most within the control of the real estate asset owner is to gradually increase the cash generated by that asset over time, which requires something Kule and I were chatting about just outside, world-class asset management. Is saying, I want to double the value of my asset. The only thing within my control is to double the cash generated by that asset. And I've found it reasonably surprising. We have people who are extremely good at building, extremely good at selling, but there's a big gap in between of maximizing the value in use of those assets, which is how you get the returns that will become interesting to the pension funds. And the second is data. It's interesting, yesterday I was looking at a presentation from a real estate broker comparing asset classes. And the slide was comparing yield to fixed income and saying excludes capital appreciation. And I'm not sure that there's any proper database that shows if you invest in real estate in Nigeria, here's a total return that you get including yield. So I think there's a lot of work to be done on the part of the asset owners to demonstrate the ability to create value in the asset over time. And then there's a sort of communication and data aspect of demonstrating to the investors that, look, this is not just a yield play, it's a yield and capital appreciation play. And specifically about REITs, no matter how wonderful an asset is about creating intrinsic value, it is completely useless to the investor without liquidity. And so there needs to be some work done to make those markets more liquid. But the funny thing is if you fix some of these things, the liquidity part would come because the investors will start finding the asset class more interesting.
Brilliant. Thanks so much for your thoughts, Fola. Patrick, I'm quite happy to have you on this panel because there are three listed REITs, and your company manages two. So I think you have a lot to tell us about managing those REITs. And just to follow on from what Fola was talking about, have you been able to sweat those assets to give your shareholders good returns? Also, I would like you to speak to the liquidity or illiquidity of your REIT.
Thank you very much, Tayo. I think while looking at REITs in Nigeria, there are two aspects. I mean, real estate does not exist in a vacuum. It is strongly influenced by two things, or I put REITs don't exist in a vacuum. One is the growth of the Nigerian economy, and in this case, I'll call that real estate GDP. And the second is the performance of the capital market in general. Those are the two things that determine what happens to a REIT, as it were. The growth of the Nigerian economy or the real estate GDP in Nigeria has not been very good. So the truth is that it becomes very, very challenging to be extremely profitable when the Nigerian economy is not doing as well, and when generally people are not as successful. So there's a decline in disposable income, there are a lot of challenges regulatory-wise and all that. So it becomes very difficult. And that is compounded when the stock market itself is not doing very, very well. So with those two things, having a REIT is quite challenging. But, I mean, it's not impossible. So what sort of makes it extra difficult is the fact that what you're competing with, which is federal government riskless instruments, pay you a risk-free rate. At a point last year, it was at 22%. So in a declining economy and declining real estate sector, you will expect a pension fund or a independent investor to make a logical decision to invest in a risk-free return that will give you such a high yield rather than a long-term investment. I mean, for instance, the REIT paid 8% last year, and I think the year before it paid 10%. So if you exclude the capital appreciation, it becomes unattractive. For instance, when they compare...
Did you have any price appreciation?
No. I mean, and that's where the market goes to, because the market, even though it's getting better and better, but the stock market is not doing as well as it should. A lot of negative sentiments. The truth is that, like most other things, a lot of things that determine if the market does well is not controlled by the NS itself. It's the economy, the politicians, and all that.
Okay,
Yeah.
I hear you, Patrick, and I just want to ask you a question.
Yeah.
It's more like a yes or no question. REITs, do they behave more like real estate or they behave more like stock?
Both.
Okay, both. All right, no
Both.
problem.
Because and the thing about real estate is that in most economies, real estate gives you stable returns in the short run when the market is either going down or not doing well. But immediately the market or the Nigerian economy starts doing very well, they will probably give you very, very, very good returns. So real estate is the type of investment you hold for a long term. Yeah.
Okay, thank you so much, Patrick. Mr. Shilaja, how do you see, I mean, banks have as well done very well, in funding real estate in Nigeria, but the problem is always the tenor and the pricing. You can't really do large-scale projects with bank debt. What do you see? How do you potentially see, I mean, from what Patrick is saying and Mr. Fowler, we're not about to get any cake from the insurance companies or pension funds anytime soon. So we'll fall back to you, the banks. You've been quite faithful. But this pricing and tenor issue, how do we try to make it match the kind of infrastructure and real estate projects that we're trying to fund?
Thank you very much. I think we need to blow out a lot of cobwebs in the things we're talking about. Real estate does not sit in isolation of the market. Capital is fungible. It will go to where it gets the best and easiest return. So real estate is just an asset class. Whether you are selling commodities, you're selling bricks and mortar, you're selling cement, it is just a commodity. That's the first thing. Therefore, if interest rates or T-bills are at 14 or 20%, the first thing my father will do is to put his money there because it's safest. So why should I put it in real estate? That's one. The other thing is there are issues around demand and supply. When we talk about REITs, the value of a REIT is based on the value of its assets. You value a REIT based on premium, that is, or profit, or premium, or discount to its NAV. Its NAV is the value of the assets, less its debt, the NOI, and then you take it because it's got something else to give. So all the total return we're talking about, whether it is the initial cash flow and the growth, plus that premium or discount, is how it is valued. So there's no misnomer again about it. Why will insurance companies or pension funds play in this? In other parts of the world, owners of assets are long-term capital holders. In Nigeria, it is not the case. So we're joking. In other parts of the world, if you want to develop, you go to a bank or a general insurance company because they have short-term income. Banks don't keep long-term cash flow. They do not borrow. They do not borrow themselves long-term. If they do it on recycled ABS and CMBSs. And if you want to exit, you exit into long-term capital, whether it is pension funds or life companies or high net worth investors. That is how it works. The model works in every part, apart from Nigeria. In Nigeria, most of our deals have been done. First of all, most of our real estate has come out of the last 10 years, organized, and most of it has been done by private equity. Private equity money is short-term money. That's why we're where we are at the moment. How many deals have exited today? Probably about 5, and we can all name them. So who are we exiting into? Those are the structural problems we have. Until we create long-term capital, and I'm afraid that has to come from the pension fund. Now, it will take a while. The pension fund money in Nigeria did not even go into private equity easily. They were dragged screaming. But they were organized. PE money was organized. They educated them. They showed them how to work, how the returns will work. And that is what our industry needs to do. How will the industry get part of this 8 trillion naira into it? Unless until we do that, it doesn't work. The banks are not going to save us because they do not have that sort of capital.
Okay, so we're going to come back to the pension fund, but just before then, I'm super excited about the way Hakeem thinks about his business. I mean, he's knocked on a particular door several times. It didn't quite open, and so he's looked elsewhere. I know you shared some thoughts on cooperatives, but I want to believe there are a couple developers in the room, and even advisors to these developers. How do you make cooperatives, how do you use this cooperative structure to potentially raise capital for real estate? Just walk us through it.
I mean, okay, I've just started also, so I can only relate what I've read about what has happened in other climes. One, I think we've been talking about crowdfunding in real estate for about 2 years now. And I think cooperative is a sort of crowdfunding through the back door because you can, for example, for our cooperative, with joining fee is 25,000 naira, unit price per share is 100,000. You could take 2 to 4 units. So we've also kept the entry point very low. It's about those who are going to join the cooperative. They're looking at what's in it for me, as she has just said. So what we also don't also understand is that there are a lot of initiatives at the federal government level, but you need organized platform to access those initiatives. NMRC and the MD there, CBN just launched my own home scheme. They've appointed 12 microfinance banks, as the channel for that. So you also need to create a platform, So what you'll do is that you create your cooperative, you bring in your members, they have targeted savings, they save towards a particular amount, and actually if you are also the developer, like we are, you're doing your development. So I'm doing 100 units now. I can take 50 people who have been contributing to my cooperative. The collateral is the asset I'm developing. So it's easier, for me to convince whoever is going to finance the balance, to say I'm in control of the collateral. I'm in control of the membership. That's the kind of method that I think we should be looking at. And the interesting thing is that there are a lot of cooperatives doing very well in this country today, particularly in the oil industry. I've spoken to a number of them. In my previous life, we used to sell in bulk to them, because they have strong membership, they have good contributing platforms, But I can't resist the temptation of talking about REITs for obvious reasons, And I think that the real challenge is that we need to crack the issue of regulatory framework. Now, we have made a lot of, and I must give it to pension. 10 years ago, we were groaning to convince pension funds to even ever consider either direct or indirect investment in real estate. So we've made significant progress. But we need to crack the regulatory framework around REITs. And I'll give you an example. When Kenya, when they were going to, they came to the party very late, just 2015, but they enacted a proper legislation that understand D-REIT, development REIT, and I-REIT, investment REITs. And the first problem you have in this country is that there is even no regulation for development REITs. So you cannot go and raise money to develop. You have to create the assets before you go and you try to unsell the asset to the REIT. So how do you create the assets? That is the challenge. So we need, the last Minister of Finance really tried to push the tax on REITs, but we need to crack that. when we crack that regulatory issue, then it becomes a bit easier with the right asset selection. You know, I was having a chat with Funke yesterday. There are so many assets, great assets in this country today. Where do you onboard those assets to? If you have no vehicle to onboard them to, it's a challenge because you can't create further assets. You know, so we need to step up our advocacy. You know, we tried, we pushed government. One or two of our members found their way into the committee, and we've achieved the little that we achieved. But we need to press more. We need to create a proper legislation that you can create your REIT as a proper flow-through, transparent vehicle. Then before Mr. Falade, you have an asset class that you can then begin to argue that, okay, the yield is lower, there's capital appreciation, you also need to diversify, you know, because one of the strongest arguments, even for real estate investment for pension funds, is also the need to diversify. You don't have to put all your eggs in all these government instruments, you know, but you need the assets first. And that's why I think we need to push this.
Absolutely. Please, can we appreciate these panelists? Can we just... All right. I trust I can do one more round of questions. Mr. Falade, real quick, I mean, just looking at the stats, it's quite stark. 2.9% of pension funds is invested in real estate, 0.1% in infrastructure. Don't you, from a diversification perspective, I mean, and I think that is the bane of investment, 70% in government securities, don't you think from a diversification perspective that is toxic to our pension and even to development, I mean, economic development of the country?
Yeah, I mean, well, to some extent, yes, you are right. But the reality is, just like we've discussed, the other asset classes are just not competing. That's just the problem. One other thing I didn't mention earlier on is the fact that right now, under the prevailing legislation, there is a minimum exposure to real estate, infrastructure, and private equity. In other words, those three asset classes have been bundled together, all right? And there is a minimum exposure that must happen to those asset classes. And it's 2.5% of the global fund. In other words, there's a 200 billion minimum on the table. Whether the yields are good or not, that just must flow to whichever of those asset classes gets its act together. And we've been seeing a lot of infrastructure funds come up. And indeed, some came and was going to raise about 15 billion. It was oversubscribed. That was towards the end of the last quarter. You know, so we are not seeing traction from the real estate side. That's reality. And just like I mentioned, we are institutional investors. We come in via the secondary market. We are not primary obligors.
Yes.
So it's when those assets are created, we are there to take them off the primary obligors. All right? And that has to happen through the capital market, which means we must find a way of quickly integrating the real estate sector to the capital market. That has to happen. And that conversation needs to be ongoing. And that speaks to some of the things Patrick was trying to talk about. You know, so we need to take these REITs very, very seriously because we know that is the primary vehicle for this to happen. And of course, we are waiting for mortgages. Mortgages will come. I mean, Kende is sitting down there. I'm sure at some point he will speak to us about what he's doing on mortgages. So that will happen. You know, but there is a 1.2 trillion available for REITs, not taken. And there's a 200 billion on the floor that must go into either private equity, real estate, or infrastructure. Infrastructure is being ramped up now. And of course, the managers are not silly. They're not going to throw away the money. All right? Because ultimately, what's the mandate of the pension fund managers? Is to ensure that when people retire, you and I, the money is there. You know, safety first, then returns. But returns, real returns, you know, on a risk-adjusted basis. That's the point. You know, so what has happened is that the asset classes are lining up. There's a maximum exposure to federal government bonds is 80%. But because federal government bond has ticked the box, it's gotten 71. So when people say you're packing, no. It's ticked the box, it's gotten its own. We're waiting for real estate. That's the point we're making.
Okay. Yeah, so Mr. Faladay throws a great challenge. So how do we match real estate to capital markets, and also the potential of seeing a lot of public debt come into real estate?
Yeah, I think it's just investing theory, because this point about diversification, you diversify to improve your risk-return trade-off. And if the risk-free asset is giving you the best return, I wouldn't diversify if I were in their shoes. So I think we're grateful that the regulator has forced some money to come to real estate. So I think the onus is on the creators or owners of real estate assets to demonstrate that at least comparable returns to risk-free can be delivered, which is proper asset management. We need to grow the cash generated from each, because nobody's interested in cement and land. It's how much cash can this asset generate. So the onus is on us to demonstrate that we can generate those returns.
Okay, Fola, this is the second time you are raising the issue of asset management, so it's absolutely something we need to look out for. Patrick, real quick, what is the status with trying to get the tax benefits on restructures, properly enforced to ensure that REITs are tax-free and even in the hands of investors?
I think the solution to that will be what has been said in this panel. We need a legislation for REITs. Without that, there are a lot of back and forth. Nobody will take no international investor will take the sector very seriously unless there's a legislation. Because you have one government, the government is in support. You have the next government, the government is against it. So, yes, as of now, I'm not sure. And right now, the entire tax, everybody wants to raise more money in Nigeria. So bringing up the discussion to give a waiver is quite difficult. So legislation has to be done on that.
Okay. So can I jump in quickly on that?
Yes.
I think a lot of the times, because we're not asking for a waiver. We're not asking for a waiver. What we're saying is that if you tax REIT returns at the entity level, and you also tax it in the hands of the REIT holders, it is double taxation. So we're not asking for a waiver. We need to understand that. So because the regulators don't understand that, we've really tried to push. But where we are now is that last year, the new regulation, if you look at item 26 on that list, 26 and 27, real REITs and REITs, you could apply for pioneer status. But that only gives you 3 to 5 years. And after 3 to 5 years, you have to come back to the same problem.
Okay, Didi, do you want to take questions?
Yeah, we want to get some participation from the audience. Does anyone have a comment? Because I imagine that you would. Okay, 2.
Thank you for the discuss. It's been very interesting. So I have a very direct question. So I'm going to go straight to the MD of custodian pension. And my question is the challenge that was posed to you in terms of how do you look at yield and total return? Because I think that's the key challenge that we are having here. And then also, when you're all talking about the liability, what about the fact that you have a long-dated liability? So if we all look back, I think about 5 or 6 years ago, you had treasury bills at 2%. So the question is, how do you also look at your long-dated liability and really ensuring you also have an asset class within that without having to force the regulation? We're talking about putting 5 to 10% in terms of international standards. So I think those are 2 critical things in terms of we have to deal with. How do we position total return versus yield? Because we can never match up to the treasury bills. And also, how do you view the fact that you're looking at treasury bills maximum 360 days? What do you do about your liabilities that you have in 10 years' time?
Okay, thank you very much.
Yes, you can go ahead.
In terms of matching the assets and liability, that's no challenge, because in fact in this environment we have instruments, 30 years instruments, 20-year instruments, 10-year instruments, so immunizing the portfolio is not a challenge at all. All right. The liabilities are long dated, I agreed, but indeed there are assets to be matched as well, and which is why we talk about mortgages, Of course, if you had mortgages and those mortgages are out there, on the secondary market to be picked up, of course, those are long-term assets as well. So by the time we, spin out all our mortgages and they're properly structured and they are securitized onto the secondary market, of course, again, it becomes another asset class to be matched at that point. All right. So treasury bills, of course, they are short-term bills. So yes, investments are flowing through them, also because they tick the necessary benchmark that is being used to screen them. But they don't fall into that category of assets required to immunize the portfolio. So that's one. The second one, you're talking about total. I mean, no one is saying that real estate must necessarily match what federal government bonds or sovereign instruments is rendering. No. Like I said, it's not as if there's competition between those asset classes. The only reason why federal government bond has gotten 70% is that, you have your criteria, and federal government bond is perhaps the leading asset class when it comes to matching, the criteria we are looking at in terms of on a risk-adjusted basis. So clearly, if you have 6 or 7 asset classes, and one of them has a limit of 80%, and on a risk-return basis, is giving you 16% when inflation is sitting at 12%, the first thing you do as a rational manager is you pack all the required 70% or 75%, and because it's risk-free. And then you now say, okay, what's left in your portfolio? And then you start to rationally reallocate. So who comes next? For instance, I had a very interesting conversation with the capital market people 2 days ago, similar gathering. They were talking about investment in equities and why pension funds are not putting the funds in equities. Foreign portfolio players are leaving in droves and so on. It's not going to happen. It used to happen 10 years ago. It was the reverse. Federal government bonds was about 40%. Equities was maxed at 20%, even with a limit of 25%, because governance was quite strong in the environment at that time. But today, look at how our companies are just dying off. We used to have a big first bank. We used to have, I don't want to mention names, but Wando and Co. I mean, look at where they are today. So they are not getting those allocations anymore. That's what's happening. So when we are talking about REITs, we have to be very serious. Governance is key here. The very first few REITs that came out in the market, they had challenged assets being packed into that asset class. And of course, the yield was ridiculous. So we have to be very, very serious about it. REITs are meant to negatively correlate equities. That's standard anywhere in the world. So when equities are going down, REITs are meant to be going up. And that is the attraction. But that doesn't happen here because of the structural problems we have in our market. But I believe when we get things right, that will be the direction to go.
I wish we could go on, but we need to take a comment from here as well, and then we need to move to a break. So one quick comment.
Well, it's not a comment, it's a question. My name is Femi Akitunde. I listened to Nii. You said 40% of the pension fund, which is 8 trillion plus, is available to only 2 classes of assets to enter the real estate industry, through the REIT and through mortgage-backed securities. Yeah? MBS. Yeah. Now, what that means is that combined, you have close to 5 trillion available that can enter in that industry. And you said that that hasn't been utilized. Is that not signaling to you that something is wrong fundamentally? Why should you have money, just like when they were saying we have money for SMEs, they are not taking it? Should we not take a step backward and review what is critically wrong? We've had only 3 REITs running. You have Mixer, you have UPDC, you have Sky Shelter. Can we ask ourselves, what's the performance of these 3? Why are we not having more REITs coming on board to allow you invest in them? Are we correct to be saying those are the only 2 means through which pension can invest in real estate and infrastructure, while we're talking of death of infrastructure stock and also inadequate provision of housing? I would like these 2 questions to be answered. Why are we not having more? What can we do differently to review the current REIT performance and get them perform better and get you to push your money back into real estate? Thank you.
Can I grab
Yes,
that?
please.
I think, again, we're so focused on this REIT business. First of all, as a real estate industry, we need to create products. There's a demand and supply issue. The pension fund industry is telling us there are no products for us to invest in. We in the real estate industry need to create products. In creating products, we have a lot of issues. And by the way, most of my my discussion is prefaced on the commercial real estate sector. The housing sector is a different story. But on the commercial real estate sector, we need to create products. To create products, you need skills, you need occupiers, and you need capital. Most of the problem is there is no debt. If you are getting debt at 25% in Nigeria, what sort of return would you get on the asset itself? It doesn't work. Because structurally in this country, the cost of capital is very expensive. It doesn't make it work. A lot of people came in with international capital. You were getting Afro dollars at about 7-8% at one point in time you could borrow. As soon as you borrow it, if you don't hedge, you're out of the money. Because if Naira devalues by 40%, you are dead. And that is what has happened to our market, where international investors ran out. And that was why I started and prefaced the whole thing that we needed to increase the participation of local investors, hence the pension funds. But by that, we need to create products. One, we need to create pure asset managers. Fola mentioned that earlier. I cannot give money to people who do not know how to create value in the asset. It is forgiving to say again, we have just started organized real estate in Nigeria over the last 10 years. It will evolve, it will happen. But if there's anything to come out of all this forum that we're having, not only to talk, we need to get a forum together to follow on the things that Hakeem has been talking about. Follow on with the government, the regulatory framework, to make sure people understand what happens. And then amongst ourselves, we need to follow on and create institutions and things that can make these investors come into it. Right. Otherwise, we will be here again next year, and the year after, we're going to talk the same thing.
Okay,
Thank you so much.
I really wish we could continue this conversation, but I'll be taking your break. And we have a designated time, and arrangements have been made outside. So we want you to go on a 10-minute break. But a round of applause for this very insightful panel. Thank you to our moderator. Thank you to our panelists. We can, of course, continue the conversation. We're here for networking. So we're here to talk about these things. We can talk about them on stage. We can talk about them off stage. But for now, we ask you to take a 10-minute break, and then you come back into this room where we will change focus to talk facilities management, changing face of facilities management. Yesterday, we talked about the changing face of the commercial industry and the residential industry. So let's move on to talk about the facility space, and then we'll go into a discussion on retail and the hotel industry. So thank you very much. Take a 10-minute break, please, and be back here just before 15:15. Thank you.